Hello, everybody. Let's try this again. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective. I believe it's my purpose, my calling to help you identify your dreams and help you reach your financial freedom destination and maintain it so that you can pass your wealth on to the next generation. If you hear that meowing in the background, that's my hairless cat. He's looking for attention. So let's see if he'll actually be on screen. Take a break. Look, this is Harry, the hairless cat, who's also a little bit hairy. And he gets meowy after he eats because he's been napping all day and he likes attention. But he'll sit here for a little bit. Yep. And then he'll scamper off. Uh, so interesting thing happened last week. So if you're on Facebook still and you click on whatever ad for whatever reason, you start seeing more of that style, more of that type of ad. So I started doing these meme reviews where I take other people's memes and I review them based upon this system of closed-end funds and this strategy, but also just general overall, I won't say common because it's now uncommon sense. So if you take all these pretty memes and you break them down, the vast majority of them aren't that good. And I'm not going to get into it here, but I saw this meme on Facebook and it was an ad. So I clicked on it just to see what was inside. And somebody automatically sent me a messenger message shortly after. It's like, hey, I saw you clicked on our ad. Surely you're interested in the system. I said, no, really not. Well, I think we could really help you. Thank you. I'm not interested. Well, you clicked on it. So obviously you need some help. No, I'm good. Thanks. And we went back and forth and all civil. And at the end of things, I was like, look, I appreciate it, but at the same time, I'm good. I don't, this is a conflicting system with mine. Uh, I know what I'm doing. I know that I don't want to do what you're doing. And I think we'll just call it there. Like, I'm good. Thanks. And then I get a message back that said, hey, we need an assistant. Do you have a job right now? It's like, well, thank you. Yes, I have a job. No response since. But the interesting thing about this meme, and it's going to post or I guess this upcoming Wednesday, the 28th, was this company wanted you to buy 36 individual stocks that all paid quarterly. Now, instead of putting all the stocks from that first month, and however they paid quarterly, they didn't define. But every stock you saw in every single month, there were 3 stocks per month, so 36 stocks. None of those repeated during the whole meme. So they could have just gone with 3 stocks for that first month. That pays quarterly. Okay. So that's 1, 4, 7, 10. And whatever happened in the second month, right? So that's 2, 5, 8, 11. 3, 3, 6, 9, 12, right? They could have kept it simple, but they didn't. They went for more data because it looks prettier. So I looked at that overall meme compared to one single closed-end fund that we own and compared them. So you could spend, say, as of last week, you could spend about $2,100, $2,150 on one single share of 12 of the funds listed and get 85 bucks a year. So maybe I think less than a 2% overall return, which is crazy when inflation is at 4%. Or you could buy one closed-end fund that has all those 12 and get for the same investment price. Like the closed-end fund, you're going to pay a lot less for it compared to MasterCard, it's like 380, right? So for if you're looking at a single share comparatively, yeah, I get it. Like that closed-end fund isn't going to pay. Um, it'll pay you a better dividend. It just doesn't look like it when it's stacked up to this. But if you're going to invest 2,100, whatever, $58 in all of these 12 for just one share and just get this measly dividend, you can invest the same money into one closed-end fund and get $205 and get a 9.5% dividend. So it's kind of like, hey, do you want to use our single stock system? No, thanks. I have a better way. And that's what I want to get into here. So this video will continue to show you what I'm offering in this closed-end fund master. You get information, the consolidation of data, the funds we own, how we filter data, and then some recommendations based on that filtered data. Reminders, this is an unedited video, right? So who knows what you hear in the background as I film these in my house. You already saw my cat. Um, I refuse to, it's not a money thing. It's just that I don't like the transparency and fakery. I would put it at, it doesn't look as honest or real as if I send all this to somebody else and have them narrate it for me or piece it together after however many takes. So all of this is raw footage, right? And then I'll be going over our financial investment strategy of using closed-end funds instead of single stocks. Yeah, so the disclaimers. I am not a financial advisor. I am a financial strategist. The information contained in the video is provided on an as-is basis and does not represent personalized investment advice. Information is from sources believed reliable, but no guarantee or warranty is made as to its accuracy. I may be invested in some of the closed-end funds recommended or reviewed in the video, and the full transparency on that is we're invested in or we own the ones colored in blue, and I'll point that out. I assume no liability for your use of the information contained herein, and I encourage you to educate yourself on the market, to consult with a licensed professional, and to know your goals before investing in anything. And though I encourage you to talk with a licensed professional to get their advice, quite honestly, because I have to say that, I also encourage you to not be afraid to walk your own path. I don't speak like the herd. I walk in limited company, and sometimes I walk alone, and I'm okay with that. So let's sort, or at least let's ID and look at some closed-end funds, which means I need to share my screen. So let's see. So this is our closed-end fund master. It's a list of all current 438 closed-end funds. Oh, look, bad reference number. Some of A3 through A40. I honestly have no idea why this resets every now and then. For a little less than 9%, which as the market has generally gone up, that number slightly goes down. That makes sense. So everything in purple has been recommended by somebody I trust and somebody I read. Everything in light blue we own. Everything in gray is grayed out for a reason. Everything in white is kind of that neutral territory of I'm not interested in it for whatever reason. Everything in green I'm tracking for any number of reasons. And I've added targets based on interest level and based on this information. So yeah, don't pay premium, meaning we want to buy things at a discount. So a buy alert, either double the historical discount, maybe double the 5-year discount, or finally below premium in some cases. Dollar cost average alert based on what we already own, and other stuff I'm just tracking. And then if you want a good place to start on, I mean, yeah, you're watching my videos, but if you want more info, I guess, on closed-end funds. I do. I read the contrarian outlook. The only service I pay for. Um, let's see. Yeah, so here's all 438. So the best way to filter is by discount. And then we further filter based on target. And yes, the file says membership view because at some point I do plan to offer a membership for access to the file. So you get everything you see on here. The flags, meaning the companies that, I mean, everybody recommends a company for any number of reasons. I just tend to keep track of everything. And if it drops off a list, then I take it off this list. And then I look for these companies as I process closed-end funds. You get all the funds with all the notes. Here's our stock history for last year. Here's our stock history for this year. And we're about to add a new tab over here. So we're going to duplicate. And then whatever video I'm working on or whatever other tabs exist on the bottom of the file, then you get those too. We're going to take these out. We come back to this full list. We want to buy things at discount, but we also kind of want to buy reliable things at discount. Um, and DMA hadn't been around that long. It's got a variable dividend and really just an ever increasing discount. It's really not been steady. I don't want, me personally, I don't want an annual dividend. Um, and then FSCO, it's been around less than a year. Their site has different data than CEF Connect, which is where I tend to get the majority of my closed-end fund info from. And then none of the people that I read, and I read several people, I get several newsletters, and I only pay for the Contrarian Outlook, but nobody has said anything about this fund. And though I am confident to walk my own path at times, and we have, it's hard to buy a fund with conflicting info. Um, so I've left it on its own. So I rank things based on discount, and then I rank things based on interest level. I just come down to the end of the targets, copy that, create a new list. This current is for whenever we buy something. I like to know what we already have. The orange GER is liquidating. So we presently own that file. So I'm still keeping, or that fund, I'm keeping track of it, but at the same time, it's not on our list of things we're interested in buying any more of. So since we're still ranked in discount, I mean, we're ranked in target, but we're also ranked in discount. We don't want to buy, or we don't want to pay premium for anything. And since GER is liquidating, it's going to get lumped into this. After that, for us in general, we don't want to buy anything new. So of what we already own, AOD, we bought a while ago. One of the first things we bought, and I want to say we bought it based on somebody's recommendation. But what I've noticed is it doesn't do well. Like there are a lot of people, there are several groups that say it's well positioned and should take off and it's positioned, all that stuff, right? But it doesn't. The discount never really changes. Um, AGD, we inherited. They bought out a portfolio I loved. Um, like great dividend, special dividend, well placed, well structured, really was like a portfolio in a can. And AGD bought it out and has done nothing. Like really, it's gained ground a little bit. Um, it was not a straight one-to-one transfer. We got less than a share for every share owned. So out of 50 shares of the original, we have 40 of AGD. Um, just not happy with the fund. Um, so as I work my way up, NVXG Technology Fund, uh, that's well structured, not just based on technology, but on the companies that use technology. Um, but in recent reports, though it started off great, like it's been around for about a year, started off great. It's now not performing equal to the market. So it went from being a 3 star because it does have a great discount. It went from being a 3 asterisk to a 1. KMF is supposedly being bought out by its sister company KYN. And same thing, not a straight one-to-one transfer on shares. So I'm just not interested in buying more of it. I like it. It's a great it's a great price for the discount, but at the same time, if it really is going to get bought out, then it's not a one-to-one transfer, then it's not helpful. Cuba, I don't like how the fund's managed. Um, at least the last 6 months, if not longer, it's been all cash, nothing in their portfolio. They sold everything, and it's a dividend reinvestment fund. So they send me a dividend, take the dividend back, and then give me more shares, which does decrease the overall share price. But at the same thing, it's not straight cash, and it's all cash. So unless they've got their money in a high yield interest fund, which I have no idea where they have the money, it's not gaining anything. Um, DMA we've already talked about. So let's go from here down. Um, all the funds with 2 asterisks are dollar cost averages based on um, our existing portfolio. So USA, as much as I like it, it's a premium. BRW likes the aggressive Fed. So a stalled out Fed, I don't know, at least in my experience, like there's more to it than this. There's a lot more to it than this, but the stalled out Fed tends to make the price go down. But how we're how we're buying things and how we're structuring things, there are numerous ways you could look at how to target these funds, right? You could base them on the overall investment. You could base them on the dividend you get. You could base them on the overall yield. Uh, the easiest way to sort them, we found, or I found, is to base them on the overall discount. So if you can cull out the discount, meaning so if you can screen out the premiums, and then if you can screen out the funds that are um, currently priced greater than their 5 year or their historical discount, then those funds are much more, those are positioned better to make a change and gain. Uh, let's see, like 25% off is like saying, it's like instead of, for every dollar you invest, you're paying 75 cents instead of the full dollar. Like that's a really good deal, right? But it's in relation to the historical average. So it's been around about 4 years. The 3 year discount is still about 25% or minus 25%. So you're getting a great deal when you buy it, but currently it's not higher than that. Now, if it's double than that or more, then that's key. Unhappy investors don't like great discounts. So when the discount gets crazy high, your investors overall say, "Hey, we don't like this." Management goes, "Fine, we'll make a change." They make a change, and the fund goes. And the fund does. Fund has a better position to do, or a better possibility of doing better. So these are all dollar cost averages for us. and they're great for where we are and where we sit. Those are great dollar cost averages, but that's not the best place for our money outside of, say, our biggest dollar cost average right now would be IGR, meaning it's just based on our investment and what it is, it's the greatest loss of return. So at 502, we could significantly impact that overall average share price. Meaning, so we'll just say we could invest the same amount, right? That's 150 shares plus what's already there. Uh, okay, when we divide that by the total shares, so it's 150, and we would buy 150, so we divide it by 300. That would drop our overall average share price from almost 7 to 6. That's huge. That's an amazing dollar cost average. And if we were going to go for that, that's great. But that's looking at it from a dollar cost average perspective. If we look at it from a discount perspective, there are a lot better ways or a lot better places we can stick our money. Now, for us, we don't want to buy anything new. So as much as I like ASG is the sister company of USA, it's been on my kind of wish list for a while, but we're not buying anything new. All of these are municipal bond funds that are um, currently discounted greater. So this one's almost 3 times the historical discount and say a little more than twice the 5 year. This one's the same on the historical. That one's almost the same on the historical. Um, but and for municipal bond funds, interesting thing about this. So we'll just pick one, NZF. It's generally a tax-free thing. So you can put in your tax bracket, whatever that may be, and it'll calculate your yield based on your tax bracket. So the yield listed here, 446, is really 572 at a 22% tax bracket. If you're at the highest tax bracket, it's a 7% yield. Um, but we're not buying anything new. The NIF has the highest, if we go back, has the highest credible discount. Right? 3 from the top, but really the highest credible. And I say that because of its history. Because when I saw it, it was like, maybe it never changes, right? I mean, 26, yeah, there's some fluctuation. But if you look historically, it's a different story. If you look at their portfolio, they're invested pretty well. If you wanted more info than just the top 10 of their 56, you could type in DNIF Holdings uh, complete portfolio, and you would go to either White Charts and look at their top 25, or go to Morningstar and look at their top 25. And if you were fortunate, you would find their complete portfolio, and it would tell you every company they have. But of what I could find, you get Tractor Supply, and not, no, this isn't everything. I get that. That's 5 out of 56. Tractor Supply, which is technology based, right? Oil based. United Health, one of the best insurance companies. Tobacco, and whether you like tobacco or not, there are a lot of people who like tobacco. Steel Dynamics, and then U-Haul. Um, so I mean, decent portfolio. Come back here, go back here. But at the same time, we're not buying anything new. So where does that put us? That puts us with these 13, but I can further wheedle that down. So after catching up on all the info for the last week and kind of looking at the projections and interesting stories here and there, HFRO gives you the greatest, it gives us the greatest discount. Now, if you're brand new, DNIF might be a great move for you, but you just got to realize it's a quarterly thing. It pays category 3. So that means regardless of when the ex dividend happens, it's going to pay you 36912. And for us, I've tended to move more monthly. And there are some exceptions to that, and some of them are on this list. But I really like monthly dividends because they're consistent and they happen every month. Um, and that's not me being condescending, but that's just me stating the facts. So that being said, if you want the greatest discount, or say greatest reliable discount that's monthly, that's HFR, which is cloud-based data management, which is all set up well for AI. KYN, yeah, is quarterly, which last year they paid on this schedule. This year it's been a category 1, a 14710 so far. So we'll see what the end of the year brings. Maybe have to restructure our dividends and portfolio to reflect that. Meaning, like I've set up our portfolio based on monthly. Variable, it's an alternating quarterly schedule. Like USA pays 1369. KYN last year, along with its sister, paid in the schedule. FGB paid that schedule. Looks like a category 2, except it pays the 12th instead of the 11th. And then I work things out based on the general category schedule. So 14710, 25811, 36912. I would like to sell Cuba. This one's going to get sold whether I like it or not. I like this company. It's just not performed well. Yeah. So over here, let's see, where are we? All right, monthly, right? Alternate category schedule. Monthly FEI. It it's a target based, yes, based on the data, but they haven't raised their dividends since the pandemic. And they have a lot of similar funds compared to some of the other oil, natural gas, and energy transfer companies we have. Yes, it's under normal, but they haven't raised their dividend. So it kind of makes me hesitant to buy more of it. Oops. NML has to raise their dividend at least 3 times since we bought the company. Um, and currently, it's below the 5-year discount, but double the historic discount. So it's still a great deal. It's still well placed. They've still been performing well. And whether you like it or not, oil is going to be around for a long time. And oil, the cutting of oil production or the limiting of oil production hurts us more than just in the gasoline, oil, and building area. Oil plays into so many different things. You you don't realize. HQL is healthcare. It I try to buy stuff under $10 because you can buy stuff under $10 and do well. This was one of the few times I didn't follow that rule, and it's not that it's hurt us, but at the same time, I found out after the fact it's an automatic dividend reinvestment program, And it's kind of that one of those one of those lifetime holds. It'll grow over time. It'll pay us more. We'll get more shares, but it's kind of the I don't know. It's the time to buy it if we're going to buy it. But I think there's other stuff on here. Um, Technology and semiconduction, more banking based, private equity, business development companies. If we're going to sell it, yeah, it's under normal or it's former normal. But to hold it, it pays a very healthy dividend and has paid a very healthy dividend. And the price should increase pending how much the Fed meddles. ZTR and GLO are both moonshots. They both cycle through about 2 years in that rise and fall of things. But of where we would go right now, uh, if we're going just based on discount, it's here. And it's an A based on not based on value of company, but based on what we would do. We'll put it over here. Uh, Oil is here to stay. The interesting comparison with these. So NML pays monthly, right? KYN pays every 3 months. So what is 3 months of NML? 17 cents compared to 21 cents. But if you look at the dividend, it pays a better dividend. The dividend's in relation to the price you're paying for it. So if you're basing things on dividend price, it's not as reliable as the overall discount price. And just because this is 9 and that's 32 doesn't mean that's any less of a value. If we look at if we look at a 5-year discount, it's a -3. If we look at the historical discount, it's -8, which doesn't say much. But if we look at the swing pattern, it's currently on the lower end of that swing. And these kind of bounces, right, which is harder to see here. The last 5, so you get 18 to 20, right? Everybody dropped. Then 20, it bounced a little, it came up. So 20 to 22, or sorry, 20, 22 bounce, came up a little bit. Now we're back down. So on these lulls, if we're playing the moonshot, on these lulls, it's a buy. And then pending your strategy, you're either selling it high in 2 years or maybe a year and a half, and then waiting for it to drop again, you buy it more, sell it, or you get the dividend the whole time, right? So you buy it low, wait for 2 years, you buy it low again, wait for 2 years, buy it low again, you collect the dividend the whole time. Or you do the same thing, except you're buying at this lull spot. So you're dollar cost averaging. You're buying on this downward sweep. And then once it hits past a certain spot, you're not buying, letting the price go up, collect your dividends. And when it comes back down at a certain spot, you're buying again, and then dollar cost averaging, right? And then you stop, let it hit up, collect the dividend the whole time, dollar cost average. So you keep your dollar cost average down instead of letting your higher buys pull your dollar cost average up, right? But if we bought it just based on price, any of these are fair game. They're all under 10. But that's why I like to do it by discount, because it's a much easier tell of when to buy something. Yeah, FGB has a historical discount near zero, which means it's pretty much break even. It's not premium and it's not discounted. It's just flatline. which sounds bad, but we're looking at it in terms of discounted money. That a flat, like a break even point is great. When you look at the last 5 years, it's at -3%, or it's a 3% discount, and currently it's at 9. So it's 3 times as discounted as normal over the last 5 years. And even though it would be a different percentage, it's like 9%, it's 9 times as more discounted as it normally is over the life of the fund. Excuse me. So of where we would go, overall discount, oil, or the moonshots, right? Or one, oops, two, or three. I like NML. It pays well. I like HTY. I like these two funds. I don't remember which Rothschild, but it's, the best time to buy is when there's blood in the street, even if it's your own. And yeah, these are down overall. All of this is down overall. But when you dollar cost average it and you focus on buying it when it's below your current average, all you're doing is decreasing your current average. I mean, all of these are great buys based on where we are in our portfolio right now. All of them are fantastic buys based on the discount. And I don't have a crystal ball. I can't predict the future. Um, the stock market generally looks forward. And I like the moonshot, but I also, and I love the KYN portfolio. But if we're just doing it on discount, then that's HFRO. So things to consider, which this video kind of made itself. I updated our data. I read all the reports. I read a really cool article on oil, which gave me just a completely different perspective than what I already had. Um, you really don't realize how far or how much oil is involved in every single thing we do, or the petroleum industry, or petrochemicals, however you want to say it. It's integrated into this laptop, the mouse I have a hand on, uh, the table I'm working at. I refinished, so uh, I sanded down the top, and then I coated it with polyurethane, and there are petrochemicals used in the polyurethane. Um, the it's so much more integrated into our current culture, current society, current existence than you realize. And by stopping oil production, yes, we're increasing the cost of gas, but we're also increasing the cost of every single other thing it's related to. Like the shelf behind me, I refinished those shelves. So the stain and the polyurethane, both petrochemical based. The iron brackets and the coating around it, petrochemical based, or petrochemical based. The other laptop, yeah, the light above me, all petrochemical based. So when we cut the production of the source of supply from all of these other industries, then the cost of all those other industries go up. And then when we re uh, redo the leases and we start production, then yes, it's going to impact the oil industry overall, and we're not going to see the immediate effects in all of these other industries. But if we can continue the production of oil, right, then we can hopefully drive the other, or maybe not drive the price, but we can hopefully curtail the pricing and allow some of these other industries to fall back down in pricing because we're producing what all of those other industries need. So regardless of what you think oil is, long term on the environment and how that plays in, Uh, Me personally, I don't buy into the whole oil is the cause of all of these things. Um, but that's me. That's a different discussion for a different day. But regardless of what you think, oil is here to stay. I mean, car wise in general, it's going to be in car infrastructure, all of that stuff. It's always going to be needed, right? Even if you could convince everybody to go electric, which you're never going to do, even if you could mandate everybody go electric, which you're never going to do, right? Oil is here for a good 40, 50 years. But if once you look into see everything that oil is actually involved with and what the petrochemical industry does with the derivatives of oil, it's here to stay. It'll rise and fall like any other corner of the market. Right now, it's lower than it has been, and that is a great time to buy it. Um, for us, HFRO, having been with the company a while, the behind the scenes of what they're doing is working. The PR side of what they're doing, it is not a good selling point to shareholders. So I have it earmarked as long term, meaning I don't know when we would sell it. Um, but at the same time, it makes me hesitant to buy more of it. It's marked number one based on discount, right? And based on overall value, based on that enormous discount. Meaning like for every dollar, we're getting it for 68 cents. That's crazy. But at the same time, forward thinking, right? It's got cloud management, data management, AI. I get that. But the source of material that helps all of that other stuff get built is oil. Um, so even HFRO, even though HFRO is first based on discount and based on the value you get in buying it at the discount, I would lean for us, I would lean to KYN, or if you wanted a monthly payer, NML, or those moonshots, because we are at the lower edge or that lower downward swing for both of those moonshots. Um, yeah, I think that's good enough for the time being. So stop. So hopefully that's helpful. I mean, those are the top selections for this week, which changed a little bit between last week and this week. Uh, I hope the content is helpful for you. I hope to give you just a different perspective than what you're seeing everywhere else. So if you like the content, consider subscribing to my channel, and then head over to Facebook and search out my group there called it's Adapted Perspective Navigates Your Finances. Um, Check out the group and then join that. I tend to talk about earned income and passive income on Facebook, and I talk about portfolio income and evaluating memes on YouTube. Try to, it's not to diversify, it's just it's a streamline of thought. It's easier to talk about uh, different types of income on different platforms. It gets less confusing that way. Um, and then beyond that, I say this every episode. I say this every time I'm on Facebook Live. You're the captain of your ship. You have the power to change your life and your financial future. Many people will offer to help you, but only you can make the choice to do it. Make it happen. Shock your world. It is far easier than what culture tells you to change your one, to get a different perspective and challenge your own way of thinking, but two, to change your overall destination. The whole point is to, right, pending goal, right? The whole point is to reach those dreams and do the things you want to do. And if that change requires just a slight adjustment of where your ship is going, right? There's so much, your dreams are so much easier to reach than what culture would have you believe, right? And your version of financial freedom, your version of retirement is so much easier to reach compared to what culture wants you to believe. You just have to do the work. So I hope you have a great week. This is Daniel Young signing off. See you on the next. Bye-bye.